Good morning. I'm Tim Nyland, and today we're discussing what is on everyone's mind, and that is why megacap technology stocks, having reported some of their strongest growth in over 10 years last week, were greeted with absolutely no price response in terms of further price appreciation. Now that calendar Q1 has reported for this group, we're going to look at megacap tech valuations relative to growth to see how this group is trending relative to the S&P 500 and the triple Qs. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. Today's webinar is an extension of the February 24th webinar below, where we discussed investor euphoria, value rotation, and core equity opportunity. All of those points made in that webinar are still valid, and I would encourage everyone to watch it. We will be elaborating on additional points made in that original webinar in future webinars. Today, I'll be using Zacks Advisor tools and the Zacks Research System to do our analysis. We're going to look at April's price performance. We're going to look at forward PE multiples. We're going to look at the latest EPS estimate revisions and then wrap up with some F12M PEG ratios. And then we're going to actually adjust the EPS GRE mean to account for dispersion around that mean. So let's go ahead and start out our analysis by just looking at some of this price appreciation that we had in April. And I have the megacap tech group up here, which is what we call our earnings certain portfolio tilt stocks. Microsoft, Alphabet, Amazon, Facebook, Apple, Adobe, and then at the bottom you can see the S&P 500 in terms of the spider ETF plotted, and you can see some spectacular price performance for the entire group relative to the S&P 500. Same thing with the triple Qs. Next slide, we're just swapping out the SPY for the triple Qs, and you can again see that every single one of the ECP tilt stocks or the megacap tech group outperformed the QQQ in April. In aggregate, that outperformance when we actually compositize this group, and again, just taking those 6 stocks as a bottom-up reconstructed composite proxy on an equal weighted basis, and looking at that group, you can see that megacap tech group performed roughly 12%, where the S&P 500 clocked in at about 5.4 in April. And when we look at the megacap tech group relative to the Qs in April, it's again 12% to roughly almost 6% for the Qs. Okay, so substantial outperformance. So the idea is that with that type of outperformance, when we look at a PE ratio, keep in mind that the price having appreciated by a factor of 2x the SP 500 and the triple Qs, one would think that this PE multiple might be expanding. And we actually, since this prior webinar that we did back in February 24th, can see that the PE multiple has actually continued to contract, and it's actually flatlined relative to the S&P 500. So we have to pay attention to this. We have to understand what is going on here. So you can see that we are literally still trading at 9-year lows for this megacap tech group relative to the S&P 500. We traded along this same channel from 2009 to 2012. And then ever since 2012, we've been trading substantially higher on a relative basis to the S&P 500. And now we've come back to 2012 levels. You can see the current 1.74 on a relative basis. The median is actually 2.05, and that actually includes the Great Recession era where we had this suppressed period here. So very, very inexpensive on a relative basis. Again, valuations haven't seen since 2012. When we take a look at the triple Qs for megacap tech relative to the triple Qs, the same exact scenario playing out. Since our last webinar, this group has actually gotten cheaper. This despite the fact that megacap tech stocks outperformed the QQQ by a factor of 2x in April. Now we are at 11-year lows. Haven't seen this type of relative valuation to the Qs since literally 2009. Okay, so what we need to do is we need to pay attention to how this relative PE F12M can literally be, in this case, flat to down with 2 times outperformance in April to this group. So again, remember that the PE ratio, price on the numerator and earnings on the denominator, if price appreciates at a rate 2 times the benchmarks, you would think that this ratio would be going up. We're going down. What's What's the issue? Well, the obvious answer, right? Mega cap tech PE valuations continue to trend down. That's the obvious answer. The not so obvious answer is that the mega cap tech EPS F12M series, the underlying PE series for earnings on that common denominator, continues to skyrocket. And this is the primary driver of why the valuations for mega cap tech continue to get cheaper and cheaper. You can see that the EPS F12M, this is our forward 12-month forecast earnings point, continues to increase at an increasing rate. We haven't seen this type of parabolic growth in earnings for the mega cap tech group in years. Okay. And so the primary issue that's holding down mega cap tech right now is in the investment community and portfolio managers concerned that this growth may not continue. But remember the calculation for EPS F12M. It's actually an interpolated point that we calculate once a week between FY1 and FY2 forecast EPS. So as each week goes by throughout the year, the EPS F12M will actually get closer and closer to EPS FY2. So again, it's just a rolling interpolation of that forecast between FY1 and FY2. And you can see the growth is literally just going parabolic, okay? So what I want to do now is I want to share the revision histories with all of you. And I'm going to start with the S&P 500 and the triple Qs. And this is really important because we literally just reported calendar Q1, and you can see the revision histories coming in. And if we start by providing context with the S&P 500, you'll see that we've had some solid appreciation, right? Roughly 14%, 11%. This is since April of 2020, 466 to 531, 537 to 596. That's some really solid estimate revisions. When we take a look at the triple Qs, it's actually even a little bit better than the S&P 500, 17.7% increase since April 2020, and FY2 up 16.1%, okay? However, when we look at mega cap tech, it's absolutely spectacular, right? We are talking 36.2%, and this is literally as of yesterday. I checked it this morning. It's now over 40%, so those estimate revisions continue to roll in. But you're talking a 40% increase in this F1 period, which is now December 2021. That estimate started on 4/30 of 20, at least on this 12-month chart, at 2074. It's now 2824. That's how you read these revision charts. Same thing for F2. We're up 28.7%. We started at 2628. We're now at 3383. These are just spectacular revision numbers. Okay. We take a look at Q1, Q2. Again, a lot of these companies having reported last week, actually most, about the only one that hasn't is Adobe. And you can see the estimate revisions, just spectacular. The thing to pay attention when I show you the Q1 and Q2 revisions is that we're only talking about a revision time period here of 3 months. So this is a 2/5. This is February 5th. We've gone up 12% just from February 5th on this mega cap tech group, our earnings certain tilts. Okay. For Q2, we're up 8.1%. So let's take a look at some of the individual names in mega cap techs. I think you're going to find some of this absolutely shocking. When you look at Apple, Apple's up 33.2% for F1. Apple's up 26.9% for F2. These are spectacular revision numbers, 380 to 506. You can read the numbers. I won't read them for you, but pay attention to the actual trend. It's spectacular. Q1 and Q2, again, we just reported, we got new guidance, up 18.3, up 12% for Q2. So 18.3 for Q1, 12% for Q2. Adobe's a little different, right? They are on a 1-4-7-11 reporting cycle. So we have not gotten a recent quarter. We'll start getting some guidance here for their quarter ending April and very shortly. And you can see some of it probably trickling in now, but at any rate, up 8.6. And the estimate for F2 is actually down 1.3 because we're still crawling out of a little bit of a COVID recovery for Adobe. Q1 and Q2 solid estimate revisions, up 4.4, up 3.8. Amazon, absolutely shocking, right? F1 up 40.8. Just look at the revision. Started out 531.20 at 38.35 for this December 2021 timeframe. We're now at 54.01. Same thing for F2, up 21.9. We're at 58.33. Now we're at 71.10. Spectacular. Amazon Q1 up 4.6. Amazon Q2 up 2.1. Again, I would expect those estimates to continue to roll in and some of these revision numbers to change, perhaps even push a little bit higher on those as well. Facebook F1, F2. Again, December 2021 up by a shocking 31.3 and 32.1. So actually acceleration in here for Facebook on F2. Incredible revisions. Q1 just as solid 16.3. Q2 up 7.5%. We look at Alphabet. This is the big shocker. If just look at this number here from last year, they were expecting 55.18 on December 2021. Now it's 85.61. Same thing with F2. The original forecast here, at least it was back on May 31st of 64.84, is now 93.69, up 44.5%. It's just incredible. Q1, Q2 up 21 basically and 13% respectively. Microsoft just continues to chug along. F1, F2 up 24%, up 17.3%. Q1, Q2, 7.31. So the idea here that I'm trying to drive home is we're trying to answer the question, are these mega cap tech valuations stretched? And so far we've discussed two themes, right? We've discussed the relative PE F12M valuations, and I've shown you that the valuations are not only cheap, right? Relative to the S&P 500, we're at 9-year lows. Relative to the Qs, we're at 11-year lows. And they're getting cheaper. And I've shown you why they're getting cheaper. They're getting cheaper because the growth in the underlying consensus EPS estimate revisions continues to trend up, and it's trending up at a parabolic rate. And so that in and of itself just continues to drive the valuations for that group down. And so my question for all of you would be, isn't that enough? Isn't that enough analysis? And the answer to that would obviously be no, right? I want to dig a little bit deeper with you. And so to answer this question even further, we need to incorporate the consensus EPS growth forecast with that forward multiple. Basically, we need to combine it into a PEG ratio. And we're going to take it even one step further. After we look at PEG ratios, we're actually going to adjust the PEG ratio itself for dispersion around the EPS GRE mean. So we're actually going to take from the EPS estimate growth forecast, we're going to remove one standard deviation from that as a measure of conservatism and look at how the PEG ratio changes. And that is going to tell us if the sell side analysts are in agreement with one another as to the trajectory of the forecast growth for these baskets. And everyone knows that I love to look at two different time frames. So we're going to look at a 10 and 15-year time frame. The 15-year trend is going to incorporate the Great Recession valuations, and the 10-year trend is going to incorporate only the post-recession valuations. And so we're going to run a little bit of sensitivity analysis here. When we look at those measures of central tendency, it's great to have an idea of what it looks like with and without the Great Recession. So let's go ahead and get started on the very last leg. I think you'll find this absolutely shocking. So when we look at mega cap tech's PEG ratio relative to the Qs, there's a couple things I want everybody to pay attention to. And that is that it's very rare for the PEG ratio to be at parity between the mega cap tech group and the Qs. It's only happened a few times in the last 15 years. Okay. We're sitting at a parity point right now. We had an inflection here in 2019. We had another one here, you could say, at the end of 2016, start of 17, and then we had this time frame coming out of the Great Recession. And other than that, you can see that those inflection points are in fact a low point. I call that parity with the Qs. And the PEG ratio trades at a premium in some cases, a very large premium over the triple Qs. And this is, again, because these earnings certain tilt stocks, these mega cap tech stocks, are literally in a league all their own. If you look at their balance sheet, the strength of their balance sheet, you look at their profitability metrics, you look at their growth, these companies command a premium, and so they tend to trade at a premium. And so what we're going to do again is we're going to pay attention and note that the fact that mega cap tech right now is trading at a little bit of a premium over the Qs. However, what we need to do is we need to remove one standard deviation of that EPS growth rate estimate mean. Again, this EPS growth rate estimate that is the common denominator of this particular fraction or ratio, that is a 3 to 5 year growth rate on earnings that comes into us from the sell side analysts. These are the estimate contributors to Zacks consensus. So because we have a basket of estimate contributors for this mean estimate, we can calculate a standard deviation around that. So we can get an idea of the variability around that measure of central tendency, and we can remove one standard deviation as a measure of conservatism. So we're going to do that in the very next slide. And what I want you to see is that we now get an inversion. So now all of a sudden we get mega cap tech that's cheaper than the Qs. So I'm going to go back one slide, and I want everybody to pay attention to the fact that mega cap tech here with just a straight PEG ratio was more expensive than the Qs. And then we take away one standard deviation around that EPS GRE mean, and all of a sudden the Qs get more expensive than mega cap tech. What this tells us is that the sell side analysts that contribute to the Zacks consensus, they are much more in agreement with the trajectory of mega cap growth than they are the trajectory of the triple Q growth in terms of earnings. So the more out of agreement the sell side analysts are, the higher this ratio goes relative to its standard PEG ratio. So you'll see these numbers were sitting at levels of 2.14 and 207. And again, once we remove one standard deviation, this common denominator gets smaller. It's going to naturally increase the PEG ratio. But again, this is a measure of conservatism, because what we're doing is we're literally trying to determine if the sell side is in fact in agreement with this long-term growth forecast. And you can see that we go to 267 on the mega cap tilts, but we go all the way up to 282 on the triple Qs. Now, when we look at this over a 15-year time span, I want you to see that both of those metrics, their current points are above the 15-year median, okay? 267 to 240, 282 to 205. But what I want you to pay attention to is when we remove this Great Recession period in the next slide, okay? I want you to see that for the 10-year period, mega cap tech names actually just breached their 10-year median, and the triple Qs are still elevated above their 10-year median. So we're going to move on now to the S&P 500, and this is where things get really interesting, okay? So you can see again these inflection points. It's the same as that we experienced with the Qs. However, we're trending down now in parity with the S&P 500. We've had some spectacular earnings come in. We've got growth. I did a webinar on why PE valuations are so high and why we can have a multiple contraction naturally without a market crash. And it's because these earnings are actually being delivered. And again, we've got growth forecasts that are in some cases aggressive, and we need to be able to do some additional analysis on our PEG ratios to determine if the sell side is in fact in agreement with this trajectory in growth that is our common denominator for the PEG ratio, which is again that EPS growth rate estimate mean. Right now, you can see the same scenario play out that we had for the Qs, where the mega cap tech group is trading at just a little bit of a premium to its traditional PEG ratio over the S&P 500. However, now let's remove that one standard deviation away from that EPS growth rate estimate mean, and look at that. Okay, this rarely happens. I haven't seen this in years. This is a 15-year chart. It's not even on this chart. Again, most of the time, this tilt group trades at a premium to the S&P 500, even when removing one standard deviation of the growth, we still catch a premium. We had a massive premium here in 2017, 2018, and now we're trading at a massive inversion. And I mean, this is absolutely spectacular. What is this telling us, right? What this is telling us, this is a red flag. The red flag is that with regards to this cyclical recovery, the analysts, the sell-side analysts that are contributing to Zacks consensus are not in agreement with each other in terms of the S&P 500 as to where this future growth trajectory is going to be. They're much more in agreement with mega cap tech. So again, remember what I said, the levels of these numbers are both going to go up because we're going to remove one standard deviation away from this EPS growth rate estimate. When we do that, if there's a higher standard deviation, remember you have higher variability in the underlying estimates, that's going to make for a much larger adjusted PEG ratio. So whichever PEG ratio revises up higher is going to be the PEG ratio where the underlying sell-side analysts are not in agreement with each other in terms of where this trajectory is going. And you can see that with the S&P 500. That's absolutely shocking. I've actually never seen this before to this extent. So again, we've had these periods of inversion. This is huge, and this is basically massive deviation around the S&P 500 in terms of where the sell side is or is not in agreement with that EPS growth forecast. So pay attention to that. And then obviously, this is absolutely shocking. When you bring this down to a 10-year chart, again, you can see that the mega cap tech group, the same with we saw when we looked at this relative to the Qs, is trading their current value below their 10-year median. Look at how elevated the current value is for the S&P 500 versus its 10-year median. So a ton of variability in where the sell side feels that growth is headed, and that's largely due to the cyclical nature of the recovery that we're in. So let's do a quick wrap up. Mega cap tech ECP tilt stocks are in fact not overvalued on a relative basis. Today's webinar is an extension of the Investor Euphoria Value Rotation and Core Equity Opportunity webinar recorded on February 24th. Please be sure to loop back and watch. You'll actually see kind of this whole thing in motion, and we will be elaborating on more of those points that I made in that webinar in future webinars. Again, I want to remind everyone, I did a 3-series webinar on tech, and I want to remind everyone, not to treat all tech equally. We've shown in the Q1 earnings that we just experienced have proven that mega cap tech ECP tilts are superior. These are not the traditional high beta unprofitable tech companies that strategists are warning investors about. And you're going to hear more and more warnings about these unprofitable high beta tech names as we continue to get inflationary pressures. And you do want to be careful. You want to watch your exposure. You want to know what you're invested in. Mega cap tech valuations continue to trend lower, right? I mean, I've shown exactly why that's taking place. And this is happening despite twice the price performance relative to the S&P 500 in the Qs in April. So pay attention to the components of those ratios. It's very, very important. We've had this massive valuation trend catalyst in those EPS estimate revisions, right? We showed how the estimates are not only rising, but they're rising at an increasing rate. So that F12M history is actually going parabolic. We have the EPS FY1, FY2 estimate revision growth. It's basically outpacing the aggregate price increases. So that's why we're getting this valuation multiple contraction. And then we dove into the PEG ratios. We looked at traditional PEGs, and then we found some red flag in actually adjusting the PEG for the dispersion around that EPS growth rate estimate mean. This is something that I recommend that you do with any type of growth forecast itself. It's really, really important. I do it with all my valuation work. If anybody has any questions, please feel free to reach out to me. More than happy to assist here. But keep in mind that that the EPS growth rate estimate mean, the dispersion around that mean is much tighter for mega cap ECP tech tilt names versus both the SP5 and the triple Qs. This means, again, that more analysts are in agreement with mega cap tech growth trajectory than they are with both the Qs and the S&P 500. Okay, and when we adjusted for that standard deviation in both those pegs relative to the S&P 500 and Qs, we got an inversion relative to the benchmark that's only occurred a couple times historically, and that traditionally marks a low point. So that's about it for this week. Thank you all for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and Twitter at Tim Nyland. If you're interested in getting started with advisor tools or ZRS, or if you're just looking to upgrade your current subscription, or if you'd like a copy of our slide deck, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you all for watching, and I'll talk to you next week.